Hi, I'm James Robinson, and this is my stock pick of the week. This week's pick is Medifast, symbol MED. This is part of a 5-part series on Medifast. We're going to do one video, which is an overview of the company, one on its operations, one on the debt, one on its dividends, and one on its ability for wealth creation. Medifast, through its subsidiaries, manufactures and distributes weight loss, weight management, and healthy living products, as well as other consumable health and nutrition products. So it sells bars and bites and pretzels and puffs and oatmeal. It sells drinks and hearty choices. It sells, pancakes and smoothies and shakes, as well as soups. And it does it through a number of brands. Those brands include Medifast, Optavia, Thrive by Medifast, Flavors of Home, and Essential One. The company sells its products through various channels, including internet, call centers, independent health centers, franchise and weight loss clinics, as well as direct consumer marketing. The company sells throughout the United States and is opening up markets in Singapore and Hong Kong. It has 420 employees and is based in Baltimore, Maryland. It was founded in 1980. It has about 24,000 direct sale independent contractors. It calls those health coaches, but effectively it's a online marketing. It's a multi-level marketing plan for selling its products. So the first question I'd like to ask about a company is, does it have a consumer monopoly? And I think this company is sort of iffy. It sort of does and it sort of doesn't. I think it's fair to say the company has a consumer monopoly in that it's a niche monopoly, and people who are used to using their products are probably unlikely to change. If you are worried about your weight, you're losing weight or maintaining your weight, and you found that you like this company's products, you find that they taste good and they achieve the goal of giving you some calories or giving you some sustenance without giving you too many calories, then you probably stick with it. It's safe to say Americans in general are overweight, and everyone's looking for a way to easily lose that weight and to maintain the weight once it's off. So again, I think if someone has had good results with this product, they're likely to continue using it. Since 2001, earnings have steadily grown from 7 cents a share to $4.62 a share. So obviously that's spectacular. The company does reward its owners, but sort of. The company pays an above average dividend yield of 4.03%. In the last 10 years, it's bought back about 10% of its shares. The company has virtually no debt, so it's very, very safe. It's also in an industry that I believe is very stable. I don't think people are going to stop trying to diet. I don't see Americans getting any thinner. The company has extremely high gross margins, which I really like. It has growing earnings. Obviously, I like that. The company has no debt, and it has very high returns on assets, as well as $120 million in cash. So this company has a lot going for it. There's a lot of things that really make me like it, and I was really surprised to see it drop like it did the other day. It dropped on news that I thought was pretty mixed. I didn't think it was warranted, the price drop that came in, but just recently the stock dropped about 30%. So would I buy the stock at its current level of 78.89? I would, and I did buy it, and so I'd recommend that you buy it at prices close to this. So as of November 11th, 2019, which is the day I bought the stock, the company had a market cap of $935 million. It had revenues of $688 million. The profits were $73.69 million. Has a PE ratio of 13.24, a yield of 4.03, and it has debt of $12.37 million. So here you can see this company's overall scores. As you know, I rank companies from 1 to 4 in 29 different categories, 1 being the lowest, 4 being the highest. This company has operating, I grade the company in 3 distinct categories. Operating, which is how well the company does it delivering goods and services to their customers. Management, which is how well the company does in terms of returning rewards to its owners. And financial, which is how well the company handles debt and risk. So in terms of operating, the company's above average, but not significantly above average, with a score of 2.89. Its management is very high at 3.5, and its financial is very, very, very high at 3.6. The total overall GPA is 3.34, which gives it a score of 89, and that makes it the 38th highest rated company I've looked at, and I've analyzed 894 companies. So this company is very, very solid. The one interesting thing is that it has very low rating in sales and general administrative to gross profit, And that's because this direct marketing plan requires it to pay hefty commissions to its salesmen. Other than that, the company seems to be very, very well run. Only a couple of twos, and most of the bad scores were in operating. It's a reasonably good operating company, but because it has no debt and because it does make some profit and gives them back to the shareholders, overall it's a really good company for us.